G'day everyone, it's Arjun Paliwal here, your co-host of the Property Nerds podcast, and I'm here with Jack Fouracre. And Jack is here to talk about cash flow with me because last episode we were all talking about negative gearing. Negative gearing obviously also means you're losing some money. And if you're losing some money, people are wondering, well, how is that a good strategy? How's that going to help property investing, grow a portfolio, or even like, how does it help Australia at all if people are losing money and getting back in tax some, right? Well, now we're going to take this episode into the opposite. We're going to go positive cash flow and talk about positive cash flow and how actually to look at it from investing. What difference does it make from a lending capacity? So please stick around for that because we're going to go into like borrowing capacity. What does a 4% yield do versus a 5% gross yield? And sorry, I just stopped there. I had a burp come out of me. What does a 4% yield do versus a 5% rental yield do for borrowing capacities? And is it all that it's made out to be? And what are the traps of positive cash flow? Because people think like, hey, positive cash flow's got some amazing things. It must be great for a portfolio. And a lot of people use it as a buzz term or a desire. Just remember, it's not a strategy. It's an outcome. You're either just making dollars in your property or you're losing dollars. It's not the strategy, it's just an outcome. So we're going to talk about going into this outcome, chasing it, the traps of it, the pros of it, and everything in between. So stick around to learn about those borrowing capacity calculations because Jack's going to uncover those as well. But Jack, mate, why don't we jump into firstly positive cash flows from a perspective of, the types of assets where they occur. There's houses, there's units, and I want to go into the first trap because units at face value tend to give more rental yields, right? And it's a big part of what attracts people to buy it.
Yeah.
But sometimes people don't know what's lurking on the other side of units when it comes to financing them, calculations for them, the numbers. Maybe give us a bit of an intel on the unit world of borrowing and what to consider.
Yeah, so it's a weird thing, like the psychology of people, they think that units are lower risk. Why is that, Because
it's maybe shiny looking. I reckon it's definitely the restaurants at the ground floor because I'm looking at it, I'm like, Guzman, ground floor Parramatta? Come on, where's the risk in that, right?
I bought a unit when I was 18, right? I didn't have podcasts like this to listen to at the time. So I made the mistake and I felt the pain, right?
Well, go back to your moment. When you were 18, what made you go, ooh, love me this unit?
I know. Like I considered it to be low risk because it was cheaper. It was just like my first property. So I thought, for some reason, I just thought that it would be low risk. I don't know. And just lack of education,
You're
obviously.
Thinking you're just like dabbling in there so it's not too full on?
I don't know. Maybe no gardening. I have no idea, but that's just... And I actually...
Speaking of that, I've never seen you garden before. So maybe,
I've got a big lawn now. I've had to get into it. But yeah, I don't know why people think like that, but I still hear people say that. It's like, I think I would just buy a unit just for my first one because it's low risk. But it's actually way more risky, right? You're buying into strata. You don't know if there's going to be any strata issues with the property. The opportunity cost of buying a unit versus a house is massive.
Right.
So it's actually way more risky to buy a unit when you look at it from an opportunity cost point of view. And although the yields look great, what you sacrifice in capital growth is just devastating.
Yeah.
And once a lot of people don't take into account the strata, which is what it is when you first buy the property, and it's definitely going to increase over time because those strata managers got to get paid. And like you never know if there's going to be special levies that pop up, like if there's structural issues or flooding or, anything that pops up, strata has to cover that. And that's going to cut into your precious yields.
Mate, you just made me think of like all these things that people are thinking from the low risk side of units, which again surprises me. But I thought of the other side, like, have you ever heard of someone in the unit world go, oh, so you made 100,000 in capital gains, did you? Well, I made $5 per week in cash flow. Do you know what I mean? Like, I've never seen someone sit proudly going, I made the $20 a week in cash flow and it cost me nothing. You would always switch places with someone who made that 6 figures in capital growth or 7 figures 100%. In capital growth rather than the $20 a week. Now, don't get me wrong. We all buy, or many of us buy for cash flow at the end. And there's ways to get to there from consolidation and strategies there. But right at the start, like going to units, you've already named a few, the stratas, the the actual issues that can happen with the building. But just talk to me about the stratas. Do they get factored into borrowing capacity calculation?
Yeah. So most units carry strata. Even some townhouses have strata or community fees, and that's a separate section in a calculator with all lenders. That is not. It's not something that's included within HEM. So HEM is just like your normal everyday expenses, like utilities, food, all the stuff that you'd usually pay for, and a lender would have a specific number for each applicant based on their income of the minimum they'd accept. And then there's things outside of that that's elective, like private health insurance, life insurance, income protection, or strata, because that's something that you, like a person who owns a unit, would pay, but not a person who owns a house. So that and it's not good for your capacity, put it that way.
Yeah.
And so it's definitely, and it cuts into your yields, but it doesn't look good on paper when you own units. And I've seen different portfolios from clients that some clients have had only units because they bought one and it did well and they thought, let me just do that 3 more times. And other clients that have had houses. And it's crazy when you look at the difference in outcomes over a long term. It's actually quite devastating that people don't get the education early on, and they just go so far down that road. And it sucks to see, man.
I'm with you. I can vividly remember a customer, Lorna, and Lorna, we'd helped her with building her portfolio, and she actually came to us in 2019. And in 2019, she had a property in her portfolio, I think since 2014 or 15, or maybe 16 latest, but somewhere in that 14 to 16 period, she'd bought a unit in the suburb of Yaguna. And that's in southwest Sydney. Now, she'd bought that for mid-4s roughly. And today, well, I mean, the last time we checked it, maybe a year ago, was worth around mid-4s.
Yeah, it's devastating.
And so when you think about that, like that's almost a decade gone.
Yeah.
And you gain no money, and you've made like all like the right decisions as a person. When I say right decisions, I don't mean the investment, but you've someone who goes, I believe in investing to gain wealth.
Yeah.
I save money. I'm financially literate in my savings. I'm working hard in my career. I'm trying to put money aside for my future.
Yeah.
I'm thinking of my family. I'm thinking of my future. I'm, looking to do research. I'm trying to buy in the right areas. I'm trying to buy affordable options. I'm getting my foot in the door. I'm not over leveraging. You're doing like all these things where you go tick, 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 tick. But then all of a sudden, just one wrong decision, it's turned. Now, that's a killer. But the second thing is right now we're at this weird time where from a cash flow perspective, obviously units are looking pretty good. They're cheap. The rents are good. But when you look at the rental yields, yes, that's attracted many people. And I'll share some data here. So Greater Melbourne, 4.93% gross yields as of July 2024 data. And for units, and then for houses, 3.43, right? Then you got Perth, 6.89% for yields, 5.09 for houses. So even the good yielding cities has still have a big gap in the units. So go figure, it makes sense. But here's the growth numbers. Sydney has had 92% house price growth for the last 10 years, 30% unit growth. Brisbane, 93% house price growth, 47% unit growth. Adelaide was the closer one, 96% house price growth, 81% units. Perth, big difference there as well, 43% house price growth over the decade and 13% only for units. So it just shows a big difference in performance, which means, look, that's a trap. You chase positive cash flow, you think the yield looks good, you think the unit's there, and all of a sudden you're met with vacancy, strata, issues in repairs, lack of capital growth. That will sting your portfolio.
But see, the cash flow is instant. They see it every week.
Yeah, it's like today.
I get this money now, and then the cash flow is something you don't see. It's something that you're investing for the future. So yeah, but when you're looking at yields, we're talking about tens of dollars or hundreds of dollars. So we talk about capital growth, we're talking about tens of thousands, hundreds of thousands of dollars of capital growth. And it's just, you can't even compare those two. Capital growth is always going to be far exceeding any sort of cash flow benefit you're going to get.
Yeah, and with the capital growth, supply is one element to it. Now, obviously, there's two types of supply. There's established supply for sale and new build supply. So check this out. Unit supply from a 10-year percentage change in Sydney was 87% increase. House supply, 26%. Like that just shows so much of a big difference there in terms of performance. Now, Melbourne, house supply decrease of 18%, but then the actual unit supply from 10 years ago increased 28%. Massive shifts there. And like on the whole topic of affordable housing, like there are still units across the country that are very affordable. So if your goal is not to create an investment portfolio or build wealth through housing with investments, and it's to actually live in a house and have that shelter and stability, like don't get me wrong, like units can offer that for you. But with these lack of price growths, they're definitely not as expensive as many people think, because they're still quite cheap in many areas. So that's just a side note there. But the thing with the building approvals in units, in the last 12 months, we've also seen building approvals in Sydney and Melbourne. So Melbourne has had 2.68% of incoming supply in Melbourne's unit market, whereas the greater housing market of Greater Melbourne is 2.05% supply, so incoming. And what that is it's looking at the last sort of 12 months of approvals and looking as a percentage on top of current stock. So even on the building side, units are still pushing forward, but from established supply, they're pushing forward. The key word in both of those, supply. It just keeps coming out. So that's the first part of, the whole cash flow in units. But Jack, I wanted to ask you on the units one more thing. There's people who buy units established and there's people who buy units new.
Yeah.
You've seen people buy new units. What goes on with lending for them? Because it's not the same as lending for an established property, right?
Yeah.
What's the differences there?
It's giving me anxiety just thinking about it.
Don't come to Jack people with a unit and a new build space. Don't do that.
Well, unfortunately they do, and we have to help them because we're bleeding hard. But
absolutely.
So when you're buying an established unit, right, most of the time you'd have a finance clause. So you'd get a valuation within that time and comes back on contract, happy days. When you order a valuation on an off-the-plan unit, you've already paid a 10% deposit that's non-refundable. So if your valuation comes in short, you've got to come up with the money. You've got to borrow more if possible. But we've seen some really horrific valuations on these off-the-plan units.
What's been an example of one? Like, what are the numbers you're talking? Are we talking 5K down? Are we talking more?
More like 70K.
What happens there?
Well, you've bought it for, say, 700, right? And 2 or 3 years ago. And then when you get it valued...
And you're probably doing it thinking, it's going to be worth 2 years more. It's going to be worth way more.
It's going to be worth more by the time I settle on it. But no, it's actually probably going to be worth at best what you paid. And then with the depreciation of it and all the supply from a new build, from a new unit complex, it's actually going to just be stagnant and probably maybe even dip. So, and when the valuation comes in that under, you either need to borrow a higher percent of the value, the current value, and pay LMI. But some people are already going in with the mindset of doing it at 90% or paying LMI. So if it comes in short, if you don't come up with it and you can't settle, guess what? You're not getting your money back and you're not getting the property.
Yeah, massive. That's like literal financial pits right there. And also, like, how much confidence does it give, or little confidence does it give, when suddenly someone's bought something, they've then had 2 years of no money on it and maybe forced themselves to settle it. What people don't realize is that as soon as that market recovers and picks up a little bit, they want to get out of it.
Yeah.
And so if they want to get out of it, it just floods that market with listings again and it turns into the seesaw. So it's a big issue there.
That's the type of stuff that turns people away from investing forever.
Yeah.
Right. And with a lot of these off the plan units or house and land packages, what people don't realize is that the people that they're buying it off, the salespeople that are selling it to them, have their commissions built into the contract. So it's not like you go up to them and say, "Oh, you're going to sell me this house? I'll pay you 50 grand for selling it to me." It's all built in with the contract, and the builders and the developers are paying these people to sell it to you and just marking up the sale price. That's not worth anything. When you get it valued, there's no value to a commission built into that contract. So you got to factor that in.
Yeah. Well, I mean, commissions, taxes is another big one. Like the red tape and taxes, like the percentages of money that goes into these new build apartments of taxes, unnecessary costs from, just commissions and things like that. It's
inflationary. It's on the contract price. Like when you look at what you're buying land. Like if you're buying a house and land package, you're buying land and then you're buying the build, right? The build has all these inflated markups, right? Like it's just, what's it actually worth? It's just going to depreciate in value. The building is not worth anything. It's going to depreciate over time. And you've only got exposure to capital growth in the land. And it's even worse for units. It's so much worse for units.
Well, one thing you've touched on is like with units, just the capital growth part, even with such poor performance in 40 years of data, people are now relying on this like catch up, thinking, it's going to catch up. So here's the thing with that. I'm going to play an advocate to the scenario and just say it does catch up.
Yeah.
You made some money on the catch up. Great stuff. But you do know that if it catches up, it's likely to return back to averages. Meaning if it's underperformed for the last 40 years, even before the catch up, and now it catches up, it's going to still go back to long-term being a worse performer.
Yeah. It's wishful thinking from the spruikers there. I know they bring it up a lot, but get away from me.
Absolutely. Now, the next thing that you do when you chase positive cash flow, so the one is you make mistakes of going into units. But the next thing is you lower your options. So we did some review here, and this is where it gets really interesting. There are about 330 SA3s across the country. Think, for those who aren't familiar with SA3s, a cluster of suburbs put together to make a bigger area for cleaner data. Almost similar, not fully similar, but almost similar to some councils. And so LGAs, if you're more familiar with that data set. When we look at the July 2021 data and July 2024 data, there's some really interesting sets here. Firstly, if you were to say, okay, well, I wanted to look at cash flow positive and try and get that with today's interest rates, you'd need over 6.5% in rental yields, more than that. Because you have to consider council rates, water, insurance, property management, maintenance, vacancy. And many people put 10% deposits down. They're not putting 20, 30, 40% down. But back when the cash rate was like 0.1%, you could get 3.5% plus rental yields and they're still cash flow positive.
Good old days.
Right? Good old days. So what happens is if you're looking at 4%, say, gross yields and plus in July of 2021, you had 155 of 330 SA3s you could buy something in and meet that yield criteria.
Yep.
Today, if you're trying to get positive cash flow and you're like, nope, I just want positive cash flow, I want a highest yielding, I want that, there are only 20 SA3 regions around the country with 6.5 yields or more. And guess what? A lot of those 20, outback, mining towns, singular economies. So you're down to like under 10.
Yeah.
And so that means as an investor, who's going to win the journey? The person who goes, I'm going to take the hit and be okay with 4% plus yields and have access to 155 major markets across the country that I can make a good investing decision in. And then within that, I'll naturally pick better yields, good growth, but I get the blinkers are off. You get to choose. Or you go to the bloke who goes, hey, I've got 20 regions to choose from. And I got to dodge a whole bunch of minefields. I got a whole bunch of single economy towns, a whole bunch of, outback, low data, under 10,000 cities or 20,000 cities, whatever it may be. That's pretty big of a difference, right?
Yeah, 100%. Like I think when people get to the back end of the portfolio and they're dissatisfied with their capacity and they just want to buy another property, they don't care what it's worth, where it is. Like they'll quite happily go and buy $140,000 property in a mining town because of that yield. And you mentioned some of the pitfalls there with that, but the risks long-term just outweigh any sort of $100 of cash flow that you're going to get in the short term.
Yeah.
So like they still don't realize that $140,000 you're still investing that money. That's still a lot of money.
Yeah.
So you can't just think, it's only $140,000. What's the worst that can happen? It'll go down to 80K. Yeah. That's still pretty bad. And for what? You're getting an extra $100, $200 a week in rent?
Absolutely.
For now, right? What happens when that single economy town isn't doing so well? What happens to your rent then?
And what happens like if you sell it and say you get your money back, your cash that you put in, right? If you're lucky, let's just say you do that. You get your money back. It's been 5 or 6 years. And I had that mistake. I'd learned from it myself. In 2016, I bought a 2-bedroom townhouse in Brizzy for 180K. And I sold that at the boom of 2022, 21 for 188. So I made no money on that. But then what I'd learned from that mistake was exactly, firstly, the supply issue. The second thing I'd learned is just because it's cheap, it doesn't mean it's a great asset. You have to look at all the data fundamentals around it. But the next thing is, when you go to reinvest that capital and you're trying to take it to good markets now, it does a whole lot less for you because inflation's made that money worth less.
That's right.
Like heck, the toilet paper, it's gone out of control, right? So the toilet paper's gone much more expensive. Toothpaste, Big Macs, whatever you call it, that same 20, 30, 40, 50 grand you had on the deal and that 180K is now worth a lot less and you probably can't do much with it other than pay stamp duty.
But there's a certain type of person that would do that, right? They're very aggressive and they haven't been advised properly for them to get to that point, right? And all of it's in their personal name, right? They didn't diversify into trusts early enough and they feel like they have to go and buy properties in mining towns to continue moving forward.
Yeah.
And that's the biggest thing. And they're still just buying it in their personal name, boom, boom, boom. But it's not everybody wants to just go that aggressive. But for the ones that do, if you invested in a trust earlier, you would have more flexibility in regards to your options.
Well, you touched on a point just then, mate, of lending. Talk to me about, because that's another myth that people think. People think that if I go from 4% yields to 5% yields, I'm going to just boost my borrowing capacity.
Life-changing.
Now, all of a sudden, that's the hack, man. You got to go into another higher yield market. And if you get there, you're going to extend your borrowing capacity. Yes, yield helps. Yeah. But how much does it really help?
Not much. So using the example of a 500K purchase at 80% on a 4% yield, just average income, right? 4% yield. If you up that same purchase price to a 5% yield, it's only going to give you an extra 30K in lending.
Just 30K.
It's insignificant, right?
Exactly. Like you could be on a property of 500K.
Yeah.
And just because the one's bathroom is nicer.
Yeah.
You've just had 30K to pay for nicer taps and a vanity and like maybe a better looking shower, a bit more sunlight, or maybe the professional photos look nicer and you just pumped up 30K and you're off and just there.
Yeah.
You've lost that just from the yield jumping up. Now, here's the thing. Because of that myth, people are now going, well, let's go for a 5% yield. And they don't realize that they've just said goodbye to 40 other locations in SA3s that they could have bought in and maybe offered much more growth.
Yeah, that would have had some growth in the yield in the short term anyway.
Yeah, you see that's another thing. Like, oh man, like that's a gold one. So for anyone, just pay close attention to what Jack just said then. The yield will go up anyway. What people need to realize is that rental pressure is more important than rental yield. If one market is standing at a 5% yield to begin with and one's at a 4% yield, and firstly, you saw the insignificant in borrowing capacity of a 30K difference. But if that 4% yield market, once you're in there and its rents are growing faster than the one with 5% yield, it won't be long till the yield on the purchase price you paid, whether it's 1, 2, or 3 years, has suddenly surpassed that. So you now got a double win. Firstly, you picked the location that you could choose for growth perspective. Secondly, you had more options as a result of lowering your yield. But then third is because you picked a market with rental pressure, it grew higher rents, and now the place that had the high yield is still high, but it's stuck at 5.2, and you're now at 5.5, 6% yields against your purchase price maybe 2, 3, 4 years later. So that's a big one. So in summary, don't fall to the trap of chasing positive cash flow as a must on your investment journey. It will come over time, because the big 3 mistakes we notice when people do that is they get the shiny unit syndrome and they start going to units. They then reduce the choices of markets they operate in. And then also they take greater risks of the assets they buy when they really didn't have to. So don't make those mistakes. Positive cash flow is an end outcome. It's not a must for every part of your journey. Yes, there's only so much losses you can take, but be patient with investing. Those losses will start to come back from the rents rising, your income's rising, interest rates changing. All of that will claw itself back. I didn't build the portfolio I have today in 2 years. It took me 10. And so that's the thing that many people forget, which is to build an 8-figure or a multi-7-figure portfolio, whatever your goals are, it takes time. And you get that because now properties that are once bought with negative cash flow are positive cash flow. So that's a big part of it all. So Jack, any last final words from you on the cash flow chasing stuff of things?
Yeah, so we've talked about it on previous episodes, but I really want to drill down on it because it's such a massive eye opener for people. So Use the similar example. You got $1 million property. It's your owner occupied property. You owe $500K, right? You want to cash out to buy an investment, but you're really conscious about the cash flow of the asset, right? So if you cash out $300K to use as a deposit for an investment, and you cash it out as it's interest only, it's all investment purpose, you only use $200K as an investment, right? Say you're buying a very low yielding property for $750, you borrow 80% against that property, right? Now you've 100% borrowed, but you've only used $200K out of your $300K deposit. Now the $100K, it's going to sit in the offset account against the cash out loan, and it can make repayments on the cash out loan and the loan against the investment property as long as it's receiving the rental income from the asset. Now, obviously that negative gearing effect, right? Your personal income and savings isn't going towards servicing this debt, right? The $100K is. That's 3 years worth of negative cash flow.
That's massive.
3 years.
And a lot can change in 3 years.
Yeah. And obviously the $100K, right? As long as it's receiving rental income and making repayments on the debt, you can use it for repairs and maintenance, all that, right? As that $100K is reducing, there's going to be an extra interest that's charged, which is still deductible, investment deductible against the asset. So, and in that 3 years, right, you've bought an asset, you've controlled a $700K asset without any of your own personal money, right? So why is cash flow so important in that scenario, right? Your own money is now just going off to paying down your own occupied debt. And say if you had to borrow, to borrow 80% against that $700K asset, if that was pretty tricky and you had to go to a third tier lender, who cares? You've cash flowed it for 3 years. In that time, you've reduced your own occupied debt. Rents have gone up, rates have gone down, rates have come down. Your own occupied debt's reduced to the point where you could refinance it to a major lender, reset the process for the same property, and then a new one.
And you know what you've done there as well? You can actually create what's called exit strategies. People have a borrowing capacity today, but then as a finance strategist, you can now go and say, well, if you get to this much income as a household, rents, salaries, bonuses, commissions included, you're back to major lenders. Or if this much income and interest rates come down by this much, you're back to these lenders. So like now you're buffering that, but then over a time period, you can shift it back knowing you have a target, because many people invest without a target. So man, that's a big one, and we should definitely keep drilling into that.
Well, let's go even deeper. So it works even better when you do that same strategy, but you buy the property in a trust, because that investment loan that you've used to cash flow the debt, it's all going to be deductible within the trust. And once you've ran out of the money, right, run out of that buffer, if the equity in the property that you've purchased has gone up enough in value for you to consolidate that cash out loan against the property, now it's secured within the trust in a corporate trustee, and you've freed up the equity on the property that you took it out of, and you can now basically reset your borrowing power. So
because it's now sat that loan that you took out as a cash out in that trust, and then that's sticking there rather than against you personally. Yeah.
So when you cash it out, obviously it's against whatever investment you've cashed it out on. But if you've used it for the trust, ideally you want to consolidate that loan over to within
back into the trust.
Yeah, eventually. Yeah. It takes time, but that's really frees up your capacity and the equity in your personal name. So
that's gold, Jack. That's gold, mate. Love the tips on finance. And for those tuning in, that's our thoughts on positive cash flow. Don't fall to the traps. It's an end goal. Do not tighten up your areas because of your yield compression that you're looking at. Look at yield pressure to actually grow higher than the yields of just now, and consider the trap of units. Do not fall to it, because we've seen some scary stories from off the planners to units established being held for 10 years and just wasted effort, wasted capital. We just do not want you to be a scarred investor that sits there 5-10 years later and goes, I don't want to do this anymore. I don't want to do property investing anymore. We've seen the other side. We've seen what good looks like, and we just don't want you to make those mistakes. So that's it from another episode here at the Property Nerds, going deep into these numbers to unpack and get you into the right decision making, with data and with insights, rather than going at it with guesswork. Catch up soon.
Game over.